I bond it? Okay, thank you. Can you hear me well? Great. We've been asked to start punctually and end punctually, so we're going to try to stick really much to the schedule. First of all, good afternoon, and welcome to the Brave New Lending, a promise of alternative credit scoring and P2P platforms. It's an honor, of course, to be invited to be your monitor. My name is Charlene Bachman. I'm the Director of Customer Success for Software Group, a technology firm that focuses on developing innovative integration and delivery channel solutions for the financial sector. For the last 10 years, I've been attending these forums, and you know, we always are talking about the latest successes in the industry, and we're reaffirming our commitment to financial inclusion. The overarching message has really been quite constant, extending the outreach of quality financial products and services, you know, maintaining or increasing the efficiency without losing that high touch. But I think at the same time, we've been realists in this journey together, and we aren't expecting to get different results by just offering the same financial products to the same segments. So the industry is continuing to innovate. We're finding new ways and new models to reach underserved segments, and we're developing new approaches to be able to assess customers, assess their risk, and understand their behavior. At the same time, we're also educating those customers, as we heard throughout the morning sessions, and investing in the financial literacy that's required to you know, make the most advantage of the digital financial services that are available. So there's also not just financial literacy, but a digital financial literacy. So maybe just as an icebreaker to understand who's in the room, we can just have a show of hands to give the panelists and I an idea of maybe who is here joining us from a commercial bank or banking sector. Okay, and who's here from the government or public sector? Okay, and then who's here from private sector? And specifically any fintechs? Okay, cool. Okay, so for the next hour, we're going to be hearing from the experts on stage. We're going to have them share some specific examples of how they're using alternative scoring models or lending platforms, or have seen these models be successful in the markets where they're working or researching, and addressing those customers, those segments that have been previously excluded, and how we're able to educate them on how to use the tools, the new tools available to responsibly access financial services. So without further ado, I will introduce the panel. I'm just going to introduce them by name. As Lotta said before, all the bios and everything are within the app, so I won't waste our time on that since time is precious today. So first I have Ms. Allison Howells. She's leading new product development for Experience Innovation Hub in Asia Pacific. Then we have Simona Columbara. He's a managing director of CRIF Corp here in the Philippines. We have Mr. Dean Yoshino. He's the Dean of the Asian Development Bank Institute, the Professor of Emeritus of Keio University in Tokyo, Japan, and also the chief advisor at the Japan Financial Services Agency, their financial research center. And then, of course, last but not least, Mr. Angelo Madrid, the country manager of Tala. So I've prepared a list of questions. I'm going to join the team now. And we're going to go through a list of questions, and at the end, we're going to be opening up for the questions that you submit through the application. So first, oh, that's okay. Sorry, I thought red meant that I was on mute, so that's good. So for Allison, what are the most common criteria used in alternative credit scoring methods today, and the risk associated with the appetite and value?
Okay. Hello. Yep. Good. First of all, thanks for having us here. We really appreciate ADB supporting the conference and also hosting us. So to answer Charlene's question, some of the common criteria. So we want to use different alternate data sources, things like that we haven't thought of before, non-traditional things that we would use. So telco data, utility data, rent data, and then thinking a little bit beyond different types of data sources like that, even things like your Uber, your Grab, your Gojek data. So to really start pushing the boundaries of alternate data sources to understand different proxies for consumers' capacity and stability to, first of all, pay back different loans or whatever it might be, financial services of some description. But also, we can also think about augmenting more traditional data sources with that as well. So why shouldn't we start to understand our underwriting criteria differently and start to evolve those different models as well? Something I think in terms of criteria, we want to also look at data that's consumer permissioned and already validated. So using things like telco, payment, rent data, they're often already validated by those particular providers. So that puts us in a better position to use those data sources a little bit quicker. Also, we want those alternate data sources to be displayable, disputable, and correctable by the consumer. So again, maybe something like using your Facebook page or whatever may not be quite the same as using your telco data. So we just want to consider what the levers are in those different data sets. And just lastly, to add to that point, we need to always evaluate a consumer's stability, ability, and willingness to repay as well. So to be quite frank, I actually don't think we do that very well today, using traditional data sources with traditional credit reports and credit risk history. So we have a huge opportunity here, I think, with new alternate data sources coming into play for us to start to say for millennials and Gen Zs who probably don't even, some of them don't have transactional history that the banks would use today. This new data source allows us to really start from scratch in a fashion with this new group. However, we can also augment the older credit reports and histories that we have as well with those new data sources to improve upon what we do today from an underwriting perspective.
So that could also then be used if somebody has maybe an unfavorable credit history, if you're then able to complement that with the alternative data that could kind of change their opportunities in the future.
Exactly, yeah.
Very cool. So the next question's for Angelo. What are the key advantages and disadvantages of offering a digital lending experience for both the customer as well as the financial service provider, and how can these disadvantages really be addressed?
Got it. Again, I want to thank again ADB and for everyone here for attending. So it's really an honor to be here today. Just let me break it down because so those are advantages and disadvantages. So I think for me, running a startup, a fintech startup here in the Philippines, I think the main advantage really boils down to making credit accessible to, I would say, there are previously credit invisible population or borrowers here in the Philippines. So it's very important because, as you may know, like in the last 5-10 years, we now live in a world where people spend an average about 6 to 8 hours a day. The Philippines is notoriously known for spending at least 10 hours a day, like one of the highest in the world. So, but it's also, together with this, it also brings with it a lot of like data that can now actually be leveraged customers can now bring their data. Data is now a currency that they can bring for exchange of goods and services. So fintech is no exception. You've seen that in other markets, in other industries. But so fintech is now using that same currency in order to be able to use that specifically for underwriting. So that's the biggest advantage, is really to make invisible people now visible. I think on other advantages is really just the customer experience. As you know, fintechs have really adopted a mobile and digital approach. So it's rapid, it's fast, it's not really dependent on brick and mortar setup. So a customer can really just do everything at the palm of their hands. So this leads to amount of like savings on their part. On the flip side, on the side of the lenders, this also means that that business model does not require a lot of brick and mortar investments or high capex. So just to give you an idea how efficient that business model is, I think for now, specifically for Itala, we've crossed about over 1 million customers, but our employee base is very small. It's just 200. So that ratio is about 5,000 to 1. So that is actually a ratio of about at least 100x efficiency versus a traditional business model. However, given that those advantages, the disadvantage is really something that is really market-driven. Like, you know, people are still not used to mobile lending. They have a lot of hesitations around it. So trust is really an embedded thing that we have to really fight. It's not easy. Like, it is very easy to launch a startup. It's very easy to throw in a technology out there, but trust is another matter. Second piece is that is really fighting or at least working against the entrenched cash behavior of this economy. I think more than 90% is still cash-based. You've seen already a proliferation of mobile wallets, and it's not really still making that dent. But I think over time, with trust and cash, these are the two things that are really going to be things that need to work on over time.
And how are you addressing that cash-based disadvantage?
Yeah, so the cash is really financial literacy, education, really partnerships with regulators and also like partners in the market. It's not one startup play. It's really a team play, if you ask me. It's really shifting the entire ecosystem from cash to digital.
And it sounds like also creating this very customer-centric where,
Yes.
it's more about serving the customer than it is creating this massive team, massive
Yes.
hardware infrastructure.
Yes, so that's why the customer first, you always hear it like being thrown around in the market,
Right.
but it's really building that product that really meets the relevant and timely needs, making it affordable, accessible to the customer. I've talked to a lot of customers, thousands of them. It's always changing, so that's the thing. And if there's no better alternative, people resort back to cash.
Right.
So it's really it's not again one company. It's going to be a ecosystem challenge.
Thank you, Angelo. So next for Simona, you are working with a number of different financial institutions. So how has the alternative lending platform, how have they achieved a reasonable rate of MPL from your experience using alternative credit scoring compared to other providers that are in the market?
So thank you, Charlene, for the question again. Good afternoon to everybody. So we agreed to have the conversation a little bit interactive and somehow controversial. So as CRIF, we are a credit bureau, and of course scoring is our core and heart. But I would say that they didn't achieve a sustainable level of NPL only using the scoring, traditional or alternative. So, one of the messages that I always give to our customers is that the scoring is very important, but cannot be your only line of defense to save your NPL. And we will get into this a little bit more later. Now, I think it's also important to distinguish a little bit or increment and give more information on traditional scoring and alternative scoring. So one flip that I think, again, both of our organization actually provide is an alternative usage of traditional scoring. So traditional scoring is really based on repayment data, loan repayment data. Now, let me give you a couple of examples of alternative usage for this scoring. One comes from one of our countries that we serve, Uzbekistan. So where on top of the credit scoring on the bureau, actually we created with World Bank an agronometric model. This is to serve the farmer and to be able in doing the credit evaluation of these farmers to marry their own repayment behavior with the actual yield of those crops and fields and so on. All of these still keeping the good advantage of scoring that is not only in helping the evaluation, the credit evaluation, but to make it very fast and cheap. Again, credit scoring make the evaluation very cheap. And that's also the other area where we help the financial inclusion. They always say, you know, with the scoring, you are going to deny the access to finance. It's actually the opposite. We enable, and these are the experience from the Philippines. So another way to use, in alternative way, traditional data, is to use the, even if these are, again, unbanked or still not fully developed in the access to finance, so they don't have directly, these potential borrowers don't have directly a profile on the bureau, we can use the similarities between their profile and the other that are in the bureau to create basically profiling. So we are not able to evaluate exactly how Simone behaves, but we are able to evaluate the people like Simone behaves. And in this way, we help also the microfinance to be able to screen more potential borrower and then get into the right market. So I guess, again, this is a balance on how to use the scoring. I will elaborate more on the other two missing factors to make the NPL working later.
Sure. But I mean, the idea that you're using traditional data to still reach the invisible, as you mentioned before, and using an alternative approach, I think that's actually quite key to point out.
Correct. Of course, we also sell alternative scores. So we create and sell alternative scores that, again, are psychometrics, for example, that, again, was not mentioned before. So based on the same principle that are used in doing interview for hiring, simply with a relation on the repayment behavior. Or, again, telco data that are also very interesting and catchy because the coverage is very, very, very wide. In the Philippines, for example, but in all Southeast Asia, but in the Philippines, the telco, so the subscribers are typically prepaid, so there's not the identity. Still, with this telco score, it's possible to cover basically 80 to 90% of the population, not only of the bankable population. So these are very catchy and interesting. Of course, you need to take them with their limitation.
Right. Thank you, Simona. Now, you'll notice that a lot of the focus of the session is going to be about alternative scoring because that's where most of our panelists' knowledge lies and experience lies. But we're thankful to have Dean Yoshino here as well to shed some light on P2P, P2P lending platforms. So I guess the question focused on that is how are P2P lending platforms establishing trust, and how has the risk of indebtedness affected P2P lending platforms' practices? And then I guess what measures are being taken to mitigate that risk?
All the past presentation was talking about the scoring and what kind of data should be collected. And I'm going to talk about how to provide finance to startup businesses and small businesses. In many Asian countries, banks do not want to lend money startups and very small micro businesses. So Japan has started about 20 years ago hometown crowdfunding. Between the customers and startups, there is an internet company. They start advertising each products, and consumers can look at those websites. And if they think it's a good product, they order it, and this intermediate company transfer money. And that is one type of the sales style crowdfunding. And another style is investment type. For example, fisherman wants to produce something, then he advertises his products. Then consumers who are interested in those products contribute some amount of money. And for example, I start to buy seaweed, which is very healthy for us, and then through this internet. And this internet company is under Financial Service Agency, FSA regulation. Japanese case, these intermediaries are very important. Trust is important. So FSA only allowed 6 or 7 companies to transact these startups and consumers. Then they are doing very well and monitoring each year. Then SMA has started to produce their own products. Then this company has provided Excel sheet for these startups. Then they have to look at every day's revenue expenses. So they started to put their data in scoring. Then we are using those scored data as an analysis. Then it comes out 3 groups of these startups can be classified in case of Japan. And some are very successful, some are very risky. And then a few years later, banks are very easy to lend money to these excellent SME startups. Then they can keep on borrowing money. And those are the experiences. So it's financial education, those startups, together with P2P lending is connected. And lastly, I think consumers, if the startup products are very good, then repeated customers come to purchase those products. Then banks start to lending money 2 or 3 years later. So it's a connection from the startups to bridge it to the banks, and then they keep on doing their own business. So there are 2 ways. One is internet sales. Another one is investment to the startups. And also this internet company advises those startups because this internet company has so many experiences. Some of the startups goes down and then difficult to come back. And some came back. Then he has access to those data and provide advices what is wrong with their startup businesses. Then they try to make it as successful as possible. So those are the experiences. So data collection, and then data can be handled. And also we provide P2P lending.
And so you're seeing some advisory services and consulting actually helping to mitigate the risk of over-indebtedness?
Yes, and especially that is creating a trust for the borrowers.
Right. Thank you, Dean Yoshino. The next question is back to Allison. How has the advent of alternative credit scoring models influenced traditional banks to adjust their credit risk profiles, and what's the result of introducing these models in regards to the impact and outreach they're achieving?
Yeah, sure. So really good question, because we can say we can use lots of different alternate data sources and different underwriting models, for example, but what's the real impact to the consumer and also to SMEs? Because I think we heard earlier in the main stage that I think around 95% of SMEs generally don't have some sort of credit history as well, so it applies to both. So Experian, which is the company I'm from, have a very heavy presence in US, and they have had some really good impact with advancing their models using some of these alternate data sources that we're talking about, whereby they've had an increase of up to 60% of loan approvals, as an example, by plugging in telco and rent data. So I think, to be honest, I think there's a long, long way to go, especially understanding the different context in different countries, in different markets of those different data sets, how they captured, the validity of them, how they're actually used as well. We need to be conscious that, like, if you're baking a cake, just because you change one ingredient out with another, it doesn't give you the same cake, right? So let's actually understand how those different things complement each other and what those different levers are, I think, is super important. And I think in the context of APAC, I think we're only just scratching the surface, to be honest, as well. But I think with digital adoption, even though we know there's a long way to go with even doing digital payments and even mobile penetration, I think the world is our oyster in terms of capturing and understanding those different data sets, so that we can have a bigger impact and use those in modelling with the banks.
And as you mentioned, APAC having much of a larger informal sector than some other regions, do you see, I guess, banks actually starting to, traditional banks that you might be working with, starting to look at new product development that are actually going to reach this previously invisible or unbanked, underserved segment? Yeah,
definitely. So I mentioned I'm from Experian, but I'm in a lab as well. So we're always experimenting with new products. And exactly to Charlene's point, even things like understanding new scoring models that can fit into credit risk scores as well. So exactly that. But again, I just want to emphasize it's not standalone. You have to understand the existing data that's captured and how those two things can complement each other, but also the gaps as well. So something I think the well, credit bureaus, banks, consumers, SME, everyone needs to be aware of is things around customer consent. So we're actually getting data that's actually consent driven. Fraud and eKYC, I think everyone knows what that is. Something that I don't hear people speak about enough is actually industry expertise for various data sets you're using. So you might go and actually go get telco data, but you might not be from the telco industry, but what does it actually mean? So you have volumes of this stuff, but what are you going to do with it? Just because you've got it doesn't mean it's good, right? Back to the cake analogy, I might have a whole bunch of chocolate, but if I don't know how to melt that to put it in my cake, it's useless to me. I might as well eat it on its own. So just understanding that a bit better, I think, is important. Yeah, that was probably the main point, yeah.
But that, I mean, having the expertise in the data set you're looking at tied with the validity, the data being validated, is very valuable to be able to have that as an asset for understanding the data sets that you're looking at, right?
Yes, yes, definitely. So probably using a slightly more extreme data set. I mentioned sort of the Grab, Gojek, Uber example as opposed to telco and rent. We don't probably understand well enough yet the proxy or the propensity